Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. Today I have another special guest, Luke Harris, who is the CEO of the Property Mentors, two-time author of Let's Get Real and Property Fit. Welcome back to the podcast, Luke.
Morning, Jacob.
So we're going to be talking about commercial property today, and let's just jump right into it. What is the difference between residential property investing and commercial investing?
Yeah, so the difference between the two, obviously the different types of buildings on a very basic level. A commercial building you can't live in, it doesn't have bedrooms and bathrooms most of the time for residential purposes. A commercial property really has differences in the sense where residential property you'll have a long-term tenant, which is usually a 6 or 12-month lease in place, which is considered a residential lease under the Residential Tenancies Act. And a commercial property will typically have a business operating that lease. So it'll be more of a commercial lease, which doesn't provide for that tenant themselves to be leasing the property and living in it. It's designed for them to operate a business from that premises.
Yeah. So in terms of leasing and vacancies, what's the difference between the actual investment fundamentals of, say, leasing to a tenant that's living in the house versus leasing to a tenant that's operating their business in the premises?
Yeah, I think, very different ways of approaching that type of investment. So if you're looking at commercial property, you're looking for a business, you're looking at very different things to what you're looking for in a residential application. So residential application, you're looking for somebody that has a stable rental history, they've not damaged the home that they've been renting, have they lived in the property for a period of time with good rental references. When you're looking at a tenancy application for a commercial property, you're more looking at the how solid the business is. How long have they been operating for? What are their cash flows like? Can they afford the rent that you're charging? Can they afford the increases that you'll be adding onto the property with CPI or other costs? Can they afford all of the outgoings, which is body corporate, owners corporation fees, council rates, land tax? These are all expenses that the tenant has to pay.
Yep.
So you're looking very much at their financials, but also looking at the directors of the company, if it's a company structure, as to how stable they are and what sort of assets they've got. So you're really looking more at the numbers, whereas with a residential tenancy, you're looking at the tenant themselves and how they're going to be living in the property, whether they've got kids, whether they've got pets, all of those things come into consideration.
Right. So do you think you need to be a bit more business-minded to have success investing in commercial?
Well, I would say slightly more business-minded because, for most people, they go for residential property because they understand it. So yes, they understand it, but often they're not treating it like a business. So really, you have to be business-minded with all investing, no matter what. And I think with commercial property, I take the same approach no matter what the property is. But for a lot of people, yes, you do need to switch your commercial mindset on, treat it like a business. But the rule of thumb, really, treat all investing like a business.
Yeah, and that actually brings me to one of your quotes in your book, Property Fit. You say, in commercial property, as with all investments, it's all about the numbers. Can you talk about what you meant by that and how you can maybe stack the numbers in your favor?
Well, I think with all investing, it's always got to be about the numbers, right? You've got to take the emotion out of your investing, whether you're looking at residential or commercial property or anything else that we've talked about in Property Fit, whether it be development or renovations, whatever it might be. But I think the key thing that people forget about is that when you're making investment decisions, you have to look at the numbers and make sure that you're not kidding yourself with the numbers. When we're talking about vacancy rates, a commercial and residential property are very different. So you might have an apartment close to the city in one of the capital cities. Typically, that apartment might be vacant for a week or two every year if you're changing over tenants, but you're very unlikely, unless you're charging rent that's well above market rent, you're very unlikely to have that property vacant for 3 months, 4 months, 5 or 6 months. So generally residential property, if you've got it up for lease, there's other comparables in the area. So if you've got a 2-bedroom apartment, 4Ks from the city, you generally know how much people are paying for those types of properties, and there's generally demand for those. So to attract a tenant, you might have to reduce your rent by $10 or $20 to attract a tenant, but you generally don't have to drop it to half. Right. Commercial property, because you're relying on external factors such as the business environment, the economy, what the government's doing, interest rates, all of these things are factored into consumer spending. All of these things are factored into when and how businesses move into commercial premises and when they upgrade and when they change over. So all of these things can change quite rapidly, and it's generally not something that's easy to predict. So when you've got a commercial property, you're not just factoring in, hey, this is how much rent I want and take it or leave it. Generally, for most people, if you're starting out in commercial property, you need to pay that mortgage. So, finding a tenant, it means a bit of an art and science as to how you select a tenant, because you might have a property that's burning a hole in your pocket with your expenses every month. You may not have many applications coming through, and you get an okay tenant apply, and a lot of people are reluctant to say no because they need the cash flow. What happens in that situation is you might end up putting a tenant into the property that's not really the right tenant for you, and you have issues later on when they can't pay or there's other issues with their business. So I guess it's getting that fine balance with commercial property in managing your cash flows so that you can afford to hold the property. Yeah. And hold it so that you can attract the right tenant for the right price at the right time. And because we're relying on external factors like what's happening in the economy, it can be more challenging for investors that don't have good financial buffers.
Yeah. You mentioned just then, and you talk about it in your book as well, that commercial property is closely linked to how the economy is performing and how businesses are performing as a whole. Let's dive into that a little bit more and how you approach investing in commercial in general. Do you take a more long-term approach in terms of looking at those macro factors as well?
Yeah, look, I take a long-term approach with all of my investing. And so everything should be a long-term approach. Of course, that's going to depend on your age. If you're investing in your 20s, 30s or 40s, it might be a bit different to people in their 50s or 60s. But generally, the economy goes in cycles. Commercial property is no different. And so you can track to a certain extent what the economy is doing, how we can do forecasting and tracking that. But yes, it is very dependent on what's happening in the business world.
But in terms of timing your entry, I know your approach towards residential is, not trying to time the market. But if it's more closely related to how the economy is performing, and as you said, if we're dealing with a bit of adversity in the economy and you're struggling to get that tenant in, is it something that you look at in terms of trying to time it when the economy is performing better?
It's a bit of both, because when you're looking at sort of trying to time any market, whether it's residential, commercial or anything in property, you've got to look first and foremost at what your situation looks like. Now, if you're going to buy half of the commercial properties out there, then you should very closely watch what the economy is doing and dive in at the right time, because you're going to be buying half of all available commercial properties. That's a huge amount of property. If you're going to buy one property, which is what most investors will do, they buy one, maybe two properties at one time, I'm talking, you're not going to be able to pick the market. There's always markets within markets. If we look at Melbourne, for example, we've got the Melbourne market. There is no such thing as the Melbourne property market. We've got the Melbourne residential market, the Melbourne apartment market, the townhouse market, the commercial market, the industrial market.
Yeah.
And then that is not just one market in itself, because the commercial market in Melbourne covers office space, it covers retail, it covers all different types of commercial property, including hotels and motels and service stations. They're all commercial properties. So it's very hard to paint it all with the same brush and say this is a commercial property.
Yeah.
And they are all performing the same way at the same time. So there's going to be supply and demand fundamentals that you need to look out for in any property acquisition that you make, but also just being mindful of your own financial position. The best time to buy a property, if it's a commercial property, is when you can afford it and when it suits your plan.
Yeah, I guess that's what I was really trying to get at was, the whole concept of markets within markets makes a lot of sense when you're talking about residential property, but with commercial, it's a little bit more nuanced, I guess, when you've got different types of commercial buildings, such as you said, factories, offices. And that does lead into a question that I have as well. Is there a better type to invest in, or again, does it just depend?
Well, that's a really good question, actually. A lot of people assume, and probably wrongly assume, that a commercial property is fantastic because the tenant pays for all the outgoings and you pay the interest costs. And in a lot of cases, you might find that a tenant pays more in rent than what the mortgage might cost. The difference with that, though, that a lot of people don't factor in is that for commercial property, you do have to factor in higher costs up front. So when you're looking at getting a loan on that property, lenders will typically want a minimum of 20% deposit, sometimes 30 or 40% deposit, depending on what type of commercial property that is. Depends on the entity and the structure. If you're buying in a self-managed super fund or a company or trust structure, there's many different ways to buy property, but the upfront cost, typically the cash injection you have to make for a commercial property is substantially higher than what it is on a residential property. So for argument's sake, if you went and bought $1 million commercial property that's vacant without a tenant in it, you might have to put in 30% deposit, $300,000 to go in as a deposit on that. And then of course you've got your stamp duty on top of that. When you get your loan, assuming you can get a loan on a vacant commercial property, because a lot of lenders won't give you a loan unless it has a tenant with income on a commercial property. It's a whole conversation that we can have, but essentially, $300,000 into that property, you could go out there and use that $300,000, assuming you can afford the repayments. You could put three $100,000 10% deposits down on residential properties. So what that means is you could have $3 million worth of assets versus $1 million in commercial. So what people are not factoring in, again, this is just generic information. This is not going to suit everybody. But if we looked at that example, and this does depend on your borrowing capacity and what the banks will lend you, but on very round numbers, on a 30% deposit that you put into a commercial property, that's $300,000 cash that you need to have available. If you've got that $300,000 and you put down 10% deposits on three $1 million residential properties, then you've got $3 million of assets in the marketplace working for you versus $1 million asset. So that doesn't mean that strategy or that scenario works for everybody, but people need to consider the actual cash input. So when you're putting 30% deposit in, you'd want the rent to cover the mortgage because you've put so much extra money in. On the other scenario where you go and buy three $1 million residential properties, it's likely that the rent is not going to cover the mortgage on that. So you might still be better off buying two residential properties and keeping your extra $100,000 for a shortfall on your payments. But I guess this is where it can get, a little bit complicated because everyone's situation is different. So to suggest, is there a good type of commercial property? It's really going to depend. I've got friends and members of ours as well that have millions of dollars and they have funds invested everywhere. They've got commercial, residential, all sorts of different properties, and they're in a very different stage in their investing career where if a $2 million commercial property comes up, they can buy that and they can afford to keep that vacant for 6 or 12 months to get the right tenant. Whereas a lot of people, they buy one or two residential properties and they think, now I want to do commercial property, and they don't have a big enough financial buffer to be able to weather the storm when there's no tenant.
Yeah, no, that's a great point.
Here at The Property Mentors, we have decades of experience investing in property. We know what to look for and what kind of impact it can have on your portfolio. We have access to brokers, accountants, and property managers to make sure your portfolio performs. Visit thepropertymentors.com.au to learn more.
You mentioned, obviously, the opportunity cost that you could use to go in and buy residential when you have that cash. But when would it make sense to invest in commercial? We've discussed the risks, but there's generally positives, right?
Well, there is. It can make sense to invest in commercial. I've got a number of commercial properties and millions of dollars worth of commercial properties that I've got, making sure that I've got good quality commercial tenants in there that are always paying on time, make sure the rent's always paid, they're long-term tenancies, they not have no issues. I guess the right time to get into commercial property is when it actually makes sense in your portfolio. So this is a conversation that you need to have with a mentor and with your accountant and make sure that there is a plan and a strategy behind it. A lot of people, like I said, wrongly assume that a commercial property is going to be this hassle-free investment that the tenant's going to pay all the outgoings. Yes, the tenant has to pay all the outgoings, but finding the right tenant, it's sort of like a matchmaking service. You've got to find the right tenant for the right property. Whereas with the residential property, if they've got 2 kids, they pretty much need a main bedroom and 2 bedrooms. Right, it's a 3-bedroom. You kind of know that there's people are going to fit into that. Whereas there's so much diversity in the tenant pool. It's finding the right commercial property. So there can be some risk associated with that.
Yeah. Okay. So let me see if I'm thinking about this in the right way. It seems the risks are higher vacancies. It's closely related to how the economy is performing. So if interest rates go up or there's some sort of adversity, then you might struggle to, again, find a tenant. In your book, you talk about 60% of businesses fail within the first year or two. So again, it seems like it's all coming down to actually finding that tenant. But once you do find it, the lease terms are longer, so you have a bit more stability around that. Is there higher yields in commercial property?
A lot of the time, yes. And now it is difficult when we're talking higher yields. One of the things that I've experienced personally is that when I had one of my commercial properties, at the exact time that it became vacant, the leasing market was flat. Right, so tenants had all of the opportunities to negotiate, and I was getting offers half of what the property was previously rented for.
Wow.
So when the lease expires, you might have a bit of security that you've got a 5-year lease in place, or maybe a 10-year lease in place. When that lease expires, you don't know what the market conditions are going to be like at that time. There might be another commercial development that's gone up next door, that's newer, has more amenities, has other facilities that tenants are looking for, and you need to spend money on your asset to make it competitive again. You might find that, there's like the GFC and COVID and those types of things happen. If you had a commercial property where a tenant vacated during one of those moments in time, you might find that property's on the market for 6 or 12 months just to get the previous rent that you were getting before. And a lot of people hope that at the end of their tenancy, at the end of 5 years or 10 years, their rent's going to go up again and they can renegotiate and they can put another tenant in there. That's not always the case. So I guess it depends on what type of commercial property you've got. If you've got something unique that nobody else has, if you've got, let's say, for example, a service station on a street corner, in a really prominent location with no competition around, fantastic. You're in a really unique position. But who's got, tens of millions of dollars to go and secure one of those because they've got a long lease with BP or Shell or one of these big companies, and people are buying the lease, not the property.
Yeah.
The security of the tenant is actually what you're buying in a lot of cases for commercial.
Right. And I'm guessing if you see something that's that obviously good, there's going to be a lot of people after it, right?
There's competition for the actual asset, absolutely.
Yeah.
And a lot of it's the same thing with any good investment. A lot of good investments are sold off market, right? They don't need to be advertised. They don't need to sit on realestate.com or realcommercial.com. They get sold through networks, which is typically how I buy property. I buy property through networks, through contacts and relationships that I've built up over 20 years now. So I don't sit there and trawl through realestate.com and look for a good deal. I go through my networks. And this is the same way with commercial property, especially when you're getting to multi-million-dollar assets. They're often not advertised. Sometimes when you will look through the financial review, if you sit there, typically the only time I read that is when I'm on a plane somewhere and I'm flying interstate, I pick up a copy of it and you'll see commercial assets there. They're actually sold on an international campaign to try and attract international interest, which might push the price up. So it depends on the asset. Often opportunities that have development upside, whereas you've got a CBD site, for example, something in the middle of Melbourne or Sydney or Brisbane or Perth, which is quite a unique development opportunity. Selling it locally might not be the best option. So they have an international campaign and they advertise it through the networks overseas. So again, there's so much diversity in the commercial property sector. It's very hard to paint it with a single brush and say this is good or this is bad. But I think investors that are looking at commercial property just need to be aware of the risks. Right? There's plenty of talk about the positives of commercial property. I'm very cautious with my investing. And of course, I want to make sure that our investors are mindful of the risks, but also taking them seriously, right? A lot of people might think that, okay, we can cover if there's no tenant for 6 months. What if there's no tenant for 12 months, right? Can you cover the mortgage on that and all the outgoings? And I think just being mindful of the lending restrictions, but also if you buy a commercial property, how is that going to affect the rest of your portfolio? So let's say, for example, you can afford that one property and you buy the commercial property. Let's say it is vacant for 6 months. If you're trying to do more investing and buy more assets, residential or commercial, if you've got no income on that property for 6 months, the lenders are all going to look at your income on that property and say, well, you've got no income on that, so that's going to affect your servicing for more debt.
Yeah.
So if you're trying to build a portfolio, you really need to make sure that you have a very good understanding of the market that you're getting into, know who your tenant is, as in profile your tenant, what type of tenant is going to be in this property, what is the market conditions for them right now, right? If you're in an industry that's suffering right now, maybe the tenants aren't looking to move, and they're certainly not looking to upscale their business, they're looking to downscale their business. So make sure you understand all of those things before you look at the property that they will be looking at.
Okay, so really getting an understanding of the exact tenant that's going to be moving in there. What other research are you doing around that?
Well, it depends on the commercial property. I've had commercial property. I did have a property that I sold last year, actually, and that had development upside. So it was in an older building and it had development upside for the future, but that was another 10 or 15 years away. Looking at the market conditions and looking at the tenant pool and looking at all of the things that were happening, it made more sense to sell that property at that time to an owner-occupier because the tenant market was weak, but the owner-occupier market was quite strong. So it was a good time to sell that property. So again, understanding the economy is really important with commercial property so that you know that you're making a good decision. If you don't understand the economy and you don't understand your tenant's business, it's going to be a lot harder for you to make commercial decisions around that because you're just looking at a building to buy or to sell or to lease rather than looking at the tenant. The tenant is what's going to bring the income in. So you need to understand who your tenant is, how their business is performing, and what market they're in.
It really sounds like a whole different ballgame to residential.
It really is. Lending is entirely different and your tenant situation is entirely different. So it very, very much is a different ballgame. The only commonality between residential and commercial is they're all buildings.
Yeah.
They're all properties. They all sit on land, and I think that's what people need to factor in. I think there is a lot of misconceptions out there about commercial property being easier and higher yield, but what's not factored in is the holding costs if and when it's vacant, and the fact that you're dealing with different market conditions. And I think the worst thing is that you might have a tenant move out of the property at the wrong time, and the market conditions are different from when you first leased it out and you can't get what you originally paid. The other thing as well with commercial property, different to residential property, is that when you're dealing with a residential issue, when you've got a tenant situation that you've got to maybe collect some overdue rent, you can go to VCAT or QCAT or NCAT in each state to resolve that relatively easily and quickly. There's processes in place for that under the Residential Tenancies Act. Commercial property, you're dealing with commercial lawyers and actual litigation.
Right.
So I guess you have to have thick skin for dealing with things in a commercial manner. If your rent is late or if it's overdue, you've got to know when to take legal action and pursue that tenant and how to actually mitigate your risks and mitigate the situation to make sure that you're not out of pocket. And if you don't have an appetite for dealing with lawyers, going through court processes, that can and does happen a lot. And you've also got to be understanding of the commercial risks associated with the fact that you might take a tenant to court for 6 months of unpaid rent and you might win that court case, but if they don't have the money, that's another story altogether. So there's another process that you'll have to go down. So I guess the commercial approach is very, very important in the fact that you're not dealing with a person, you're dealing with a business.
Right. When might it make sense for someone to even start thinking about this? As you said, you sort of have to have fairly deep pockets to weather the storms and knowledge and skills around this. When would it make sense?
Well, when it makes sense really is if and when it fits part of your strategy, right? So for a lot of people, commercial property is just something they shouldn't get into. Very simple. There are a lot of experts out there that only recommend commercial property, and there are ways to invest purely in commercial property. It's just a different way of doing things. It's like saying, look, I'm in Ely Beach, you're in Melbourne, let's go to Sydney, right? You'll take a different pathway to the pathway that I'll take, right? Two people could leave Melbourne and take a different pathway to get to Sydney, right? Doesn't mean that one's right and one's wrong. It just means that there's going to be a different journey for each person. One might take longer and one might get there faster. But really for me, the advantages of residential property, and we're talking brand new residential property, which give you the highest tax benefits, which are easier to lease, which have the lowest maintenance, so many positives on that side. And the fact that the banks love lending in that space means that we're using mostly the bank's money with less of our own money going into the deal. And if we can use other people's money, use the bank's money to build our wealth, then do that first. And if you really want to get into commercial property, once your portfolio is at a certain level, then perhaps add some commercial properties into the mix once you've got the financial buffers there, once you've got your asset base there. Banks love lending money for commercial property when you've already got a multi-million-dollar property portfolio. They know that they've got something to fall back on if something goes wrong. But if you're on your second or third or fourth property in the residential space and you want to go and buy a $2 or $3 million commercial building, you've got to make sure that you can afford that and not ruin all of the work that you've done building your residential portfolio.
Yeah, okay.
Something goes wrong, you might have a domino effect where you're struggling to hold on to the commercial property and you have to sell down your residential portfolio to hold on to it. And so I think that's where the planning is super important, because a lot of people just dive into it without understanding. And we talk about this all the time, Jacob. You've heard me talk about it 1,000 times about the jigsaw puzzle. You've got to know what every property is in the portfolio for.
Yeah.
So when is the right time to put a commercial property in? I don't know. It depends on what the end picture looks like and what your financial situation looks like, and really what the portfolio should look like to give you the outcome that you need.
Yeah. And I think that's a really good way to wrap that up. And moving on to maybe a different use case for commercial is how business owners can utilize commercial property while running their business. And a famous example of this is the story of McDonald's. So if you're not aware, McDonald's actually own the land that their restaurants are built on. And then they lease out that land to their franchisees, and the franchisees pay them rent. And in doing some research for this podcast, I actually found this very interesting. And it is sort of a different conversation than the one we've just had, but I think it's really interesting to point out nonetheless. The way McDonald's does it is their real estate investment trust makes up 40% of their market cap, but brings in 80% of their profits. So most of their profits doesn't come from the royalties that their franchisees pay them. It comes from the rent that the franchisees pay them, which I think is very interesting.
It is. Well, when you look at that, what makes more sense, buying property or selling burgers?
Yeah.
When you look at that, it's not necessarily something that most investors can replicate. However, if you are running your own business, it might make sense to go and buy the premises that you need to operate your business from.
Yeah.
If you're currently renting a premises, it doesn't mean that you can automatically just go and buy it. The vendor may not want to sell it. The owner might not want to sell it, right? Because that might be their retirement income and they need your rent to live off, which is why they bought that asset so many years ago. But it is a good model when you think about what McDonald's doing. And McDonald's is not the only example of that. It happens in many, many situations around the world, but it's probably the best example in a model that really works like a dream. A lot of people think that McDonald's is so successful because of their burgers. They're probably successful because of their property portfolio. The food is what it is, and it's convenient, and it's everywhere. But underneath all of that is the real estate empire, which really is the McDonald's business. So it's quite an interesting story to read up on. But again, replicating that is not something that's very easy for anyone to do. So it is good to be aware of that, but trying to replicate it or to do that is going to be very difficult.
Yeah, no, I definitely agree with that. But on a more micro level, if you are a business owner and you are thinking about doing that, as you mentioned, it might be the case the vendor isn't willing to sell that property, but when might it make sense for someone to employ this sort of a strategy, and how could you make it work?
Well, the first thing you'd want to do is talk to your accountant, okay? Because your accountant's going to be the best one to advise you on, your financials and whether this is the right move for you. But you've also got to look at what type of business you're in. So if you're buying quite a unique business in something like manufacturing or in something that's quite a customized business, what's the outlook for that property itself over the next 5, 10, 15 years? You've got to look at your age as well. If we look at, say, a mechanic, for example, if you're a mechanic in your 50s and you're looking at saying, I want to buy a mechanic shop that's got all of the stuff fitted out, what's that industry looking like in 10 or 20 years' time? So when you need that commercial premises for retirement, what is that property going to look like in 20 years' time? Are mechanics going to even be around in 20 years' time? And that's a genuine question you need to ask in some industries. Is my industry even going to be around? So if I buy the property now, the purpose of buying that property is for your retirement, right? So that you can rent. Once you've finished running your business, you can either sell the business to somebody and they continue to operate, similar to the McDonald's, where they sell you the franchise and then you lease the property back from them. You might sell your business as you want to retire and you lease the property back to them. If you're in a good location, you've already got customers coming in, maybe that's the strategy. But if you've got a mechanics business, maybe everyone's going to be driving electric cars in 20 years. There's no motors. So what do you fix? You just change the brake pads. I don't know. Change the battery every now and then. So you might have to adapt your business and put extra infrastructure in to account for that. There are different types of retail, motels and hotels, all those types of investments as well. So it really does depend on what the end game looks like. And also, is your industry still going to be operating the same way it does now, or is it even going to exist when you get to retirement age? So you've got to really look at that. And also you've got to think, well, if I'm running my business, should I be buying that premises that I'm in? Because what if I don't want to run that business anymore? Now, it's a genuine thing. A lot of people get sick of running a business. They want to do something else, try something different, or the business might not even work. So you'd want to make sure that you've got solid financials behind you in your business, which you're going to need for lending purposes anyway. But you want to be very, very sure of your future growth for the business. So you're not going to outgrow the premises, and also that it is something that makes sense as an investment long term if something changes. So it really is a very individualized conversation to have with your accountant as to whether it makes sense to buy the commercial premises that you're operating your business from, or buying a premises and then moving your business into that.
Right. So it sounds like if it works, it might work well, but you really just got to think ahead.
Well, it can do for a lot of people. Like I've bought all of the commercial property that we run our businesses from, and it makes sense to hold them for the long term. We're not going anywhere. We've been doing this for nearly 10 years. We've got many more to go, and we're growing. So we've got extra space to grow into as a business, and we've planned for that. So that's part of our planning. Whereas a lot of people might buy a business premises to operate from, and in 5 years' time, it's not suitable for them anymore. Their business changes or adapts, or they might downsize or upsize their business, and they need to change their game plan because they didn't think far enough ahead. So really it does come down to what type of business you've got. And if you did expand, how would you manage that growth? So that comes back into business planning, the same way you would do with your property portfolio planning. Generally, you've got to think also when you're buying to owner operate your business, a lot of people will do that in a self-managed super fund on advice from their accountant. Again, that's why I've said talk to your accountant. I can't advise you on that. But at the end of the day, a lot of those loans are principal and interest loans. They want you to pay them off. Okay, so you've got to consider when you're planning on exiting the business, how old you are, and when you do exit that business, have you paid off the debt on that property? Because if you are operating your business from that, the last thing you want is a huge mortgage on it at retirement age, because then your only option will be to have a tenant in there, which still means you're paying the mortgage. It's not going to help you in retirement, or perhaps you've got to sell the property,
right?
Which sort of defeats the whole purpose.
Yeah, and then you're dealing with those other risks, such as finding the tenant again.
That's correct. Yeah, like I said, if you've got a really customized and unique business, then you might have a certain fit out that doesn't suit most businesses out there, which means you might have to spend a substantial amount of money refitting the property to make it suitable for a more wider range of tenants. Yeah,
no, that's a great point. Well, Luke, to wrap up, do you have any final thoughts on anything that we've discussed today?
Look, I think commercial property is great for a lot of people. It's not great for a lot of people. So it really comes back down to the plan. I say this on every interview, every call that I do. It's got to fit into your long-term plan. So if you are considering commercial property, just make sure that you've had really good conversations with your accountant, financial planner, and mortgage broker as to how you plan on funding it, how you plan on keeping it, and of course, how you plan on protecting it, right? Because obviously, if you don't want to be holding commercial assets in your own personal name, because obviously a tenant, something goes wrong with that property, they'll sue you personally. So you need to be looking at companies and trusts and how you can protect and shield yourself from the commercial risk and the tenancy situation. So there's a lot of things to consider. Get good advice, make sure it fits in with your plan. And also, if you've got your heart set on commercial property, look at alternatives. Look at residential property, look at other options that might actually help you to get there faster and safer than what you could do with other investment opportunities.
Yeah, awesome. Well, I won't ask you my first ending question because we've actually got a whole podcast episode on your favorite books. But Luke, I will ask you, what are you excited about for the future?
Well, the future's often people say future's looking so bright you need sunglasses, right? And I think that's a really positive way of looking at it. I'm a bit of an optimist when it comes to looking at the future, especially when we're talking about property and investing. Look, we've got a housing shortage here in Australia. The government's just come out saying they're going to build an extra 1.2 million homes from 2024. We desperately need more affordable homes in the country. I'm excited about the fact that we have opportunities. There's a lot of challenges in Australia in the property market. And in the economy, there's a lot of headwinds, but that also creates opportunities. And I think those that are ready, willing, and able to take advantage of the opportunities that present themselves over the next 5 to 10 years are going to be in the driver's seat really for setting up their financial future. And I think now is an exciting time. I've always said this though, mind you, to put a caveat on that, I've always said that it's always an exciting time to be in property. But the thing is that where we're at right now, we're in a very different world. We're in a very different geopolitical environment. But when weren't we? You know, the world's always been in a very interesting state. There's always something we could focus our attention on, and countries, beating their chest about wars and all sorts of things. We've just come out of COVID. We've got all sorts of other issues in the world right now, but they all present opportunities. And I think if we're looking at it the right way and we have the right mindset and focus on our goals and don't let the noise distract us, don't let the media distract us with all of the noise that's out there, focus on your goals. And that's what's exciting for me, because nobody can say or do anything that's going to change my goals. And I'm excited about achieving my goals and continuing to achieve my goals, because that's why I'm here. I'm here to do those things, and it's a lot of fun. Yeah. It really is.
That is exciting. And to your point, Luke, we've talked about the graph about the property prices in the past, and at each historical event from the GFC, depressions, everything, it's just up and to the right.
Well, most people, if you don't invest today, you'll be looking back in 5 or 10 years ago wishing that you did. And I think that's the thing, is that today's the first day of the rest of your life. Get started. No one's going to do it for you.
That's a great point. Well, Luke, thanks for your time. It's been great having you on, and I look forward to having you back on again.
Thanks, Jacob. Take care.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.